It's time right now for Charting Futures, and Abigail Doolittle is taking a look at the sell-off in commodities and what, Abigail, you say is one possible bright spot.
Well, actually, that is a trader that we have on today who is going to point out a bright spot, but it doesn't look like it could be a bright spot within this bit of a sell-off that we have here for commodities that you were talking about. Of course, all of this risk-off action on fears around the coronavirus and that it could really stall global economic growth. But something interesting is happening here, Romaine. If you take a look at what we have over the last week, the S&P 500 E-mini futures down 2.1%. Compare that to the commodity complex, down 4.5%, more than double the decline for the S&P 500 futures. That's the worst 5-day slide for the commodity complex going all the way back to 2015. We see much of it coming from Brent crude. We also see copper down in a big way. All of this has to do with the fact that these natural resources, that China is the world's largest user of natural resources. And if there is any sort of economic slowdown around the coronavirus, it would really sort of hit these commodities first, which also are less liquid. But this has been the story for quite some time. If we take a look at a chart that we've been taking a look at often because it has an important message, what we're looking at here is going back to the start of the trade war, which we have not talked about in a while. But in white, we have the S&P 500. In yellow, we have that Bloomberg Commodity Index. And we see at the start of the trade war that they were roughly trading in the same direction. But then in June of 2018, we see the commodity complex going decidedly lower, even as stocks were putting on all-time highs. And that fourth quarter volatility of 2018, stocks catching up to that commodity weakness. But last year into this year, take a look at the S&P 500 there, going simply parabolic. That Fed repo action, that liquidity hitting stocks, not so much for commodities. Commodities now down this period down 15%. If a lower low is put in here, it could really get bearish for commodities. Again, less liquid, less prone to being helped out by Fed liquidity. This could, in turn, be a bearish tell for stocks. To talk more about this and that bright spot, I'd like to bring in Steve Sosnick of Interactive Brokers. And Steve, that's some chart. It really could have a bearish message for stock investors.
You have to wonder how long you can have a divergence like that. If the commodities are telling you the global state of the economy, stocks are based on that global state of the economy, something's got to give.
Something's got to give, indeed. However, there is one commodity that you like in particular, and it has to do with a different divergence. If we take a look at a chart here of gold futures in yellow and silver in white, talk to us about what you see here and what you like.
For the longest time, gold and silver more or less moved together. Silver is the little brother to gold, so to speak. But then you could really see sort of around 2017 and more vividly through 2018 and 19 through now, gold has really taken off in a way that silver hasn't. The logic that I would say behind that is gold, has the precious metal status as an inflation hedge. It's also gotten a lot cheaper to own a hedge of the type of gold as the Fed lowers rates. Silver's got an industrial component. That's probably why it hasn't moved along as well.
So at this point, to your point, though, there's a greater than 20% spread between silver and gold that typically do trade together. And you say that silver actually has properties that may be interesting around this coronavirus fear.
Yeah, I was looking at it first as just a catch-up trade. And then I started to look into what do you use silver for? Antimicrobial.
Wow.
That's the kind of thing that may get people's attention in this type of environment.
It certainly could. Headline. So you would play this bullish silver futures trade through the options this way.
Basically, another interesting thing about precious metals options, silver does count here, is the skew is different than you see in equities, where above market options have a higher implied volatility than below market options. So you actually kind of get paid to sell the out-of-the-money calls. So I would say buy an at-money or slightly out-of-the-money call, finance that by selling a more out-of-the-money call at a higher volatility. In this case, when I thought about the trade, there was about it only cost you about 9 cents, and you can more or less double your money, come close to it if it all pans out. If not, your loss is quite limited.